Well, it has been a particularly bad quarter, worst in 13 odd years, and something which I must say I did not expect, and I don't think most people expected it to go as bad as this. Those who are worried about it, I have to say I'm not worried about it, because I've never owned so much silver or so much gold that a decline would worry me. The whole point about investing is you should never own so much of anything that when it goes down, you feel in a panic. Having said that, I have been using the decline to top up a very small amount just this week. It's tinkering at the edges, but I couldn't help feeling that the bottom might be in, just a feeling. But I've got lots of firepower if it goes lower, but I'm not going to be increasing my position significantly, even if it does go lower. So what's gone on? We had this massive rise in January as silver hit an all-time record of about $125, if I remember rightly. And then I believe there was the appointment of Kevin Walsh, which spooked the market, or at least that's what people said, because he was perceived as being quite hawkish. And indeed, last week he gave a speech which kind of, in a way, sort of reaffirmed that. He said, the Federal Reserve will not be interfered with by government, and we're very independent, and the inflation target of 2%, we have to get there, and inflation is too high at the moment. So people, he is perceived as hawkish. Now, higher interest rates are generally bad for precious metals. At least that's the way markets perceive it. But what happened in January, that was the trigger. But I think there's also a lot of vested interest. The bullion banks who are there to make money for themselves, and quite rightly, everybody's in the market to make money for themselves, but they have a privileged position. They can see all the stop losses and all the limit orders. And when they see a large number of stop losses lined up below the present price, which was over $120 at the time, they can see that if one gets triggered, it will trigger the next one, and then it becomes a roller coaster. Now, if you're a bullion bank and you can see it like that, it's very easy to know that if you start to trigger the stop losses, the price will be driven down as each stop loss triggers the next one, driving the price down fast, leaving you as the bullion bank you can then wait till you get to a certain level where there's no more or not enough stop losses to keep the thing going. You can then step in and start being a buyer, which means that you now have the option potentially of pushing the price back to where it was. Now, that hasn't actually worked for them this time, because although it did briefly, they pushed the price back up. We had a nice bounce. The size of the fall then triggered a lot of people who'd come in very late in the year, sort of people who'd bought in, let's say, October through to January, who'd paid well above $50 an ounce, who said, oh my God, it's going back to what I paid for it, or it's already gone below what I paid for it. I'm out of here. I'm going to chase the next big hottest thing, which of course the hottest thing at the moment is still AI stocks. So a lot of people got very frustrated and couldn't bear the thought of losing any more money. So they started bailing out. So at the moment, the bottom line is everybody who's got some silver who bought any time after about October is in losing territory. Those who've had it for many years probably they're perhaps all disappointed that with hindsight, they didn't sell at the absolute peak. But, I've had gold and silver for, more than 40 years, actually. I mean, I got my first gold coin when I was 14 years old from my grandfather, and I bought my first one sometime between the age of 18 and 21. I went to Sharps Pixley. I was working in the City of London and bought one at that time, and I continued to buy it. So the fact that I bought these coins over the years, and I never stopped really. Whenever you've got a bit of spare change, it makes sense.
Do you still have them? Do you still have your first coin?
Yes, my grandfather told me to never sell it, and he was right.
Did you listen?
He also said I shouldn't tell anybody about it, because I think at the time he gave it to me, it might not have been quite legal to have a gold coin. I'm not sure about that, but but it wasn't. When I got it, was probably worth about £3. It would be worth about £4,000 today. No, we're talking about sovereign. Yeah, it'd be worth about £1,000 or £800 today. But when I went to get it valued for the first time at the age of 18 or 19 or 20, I went into shops, Pixley, with my sovereign and said, can you tell me what it's worth? That was the way to find out. And they said, well, we'll give you 10 quid for it. Maybe they said 15 quid, or we'll sell you another one for 20 or 25. And I didn't like the spread, which sounded absolutely mammoth at the time.
Yes.
Not that I had any intention of trading at all, but it certainly reinforced my idea to keep it. Over the years, I went back again from time to time to check on it, and it always just seemed to be worth more than the previous time, and that sort of led me to be a buyer.
I suppose there's a lesson in that there is a different value, and institutions have quite a lot to do with the value that we pay, right? So I think I agree with a lot of what you just said. I think the wash coming in the beginning of the year certainly spooked markets. We also have to realize, I think, as gold and silver owners, that we don't make the market, right? There are market makers who do that, who work on the exchanges, and their trading ultimately determines the actual price. Now, some people might think that, well, it doesn't actually determine the actual value, but in the short term, at least, or medium term, the whole price finding is happening on, COMEX, or along the metal exchange or whatever, which is all sort of the same thing. So, yes, there is money to be made in things going down, right? And they might be shorting it, and they're aware that the people who, at least the smaller traders on these exchanges, use a lot of leverage. So you can squeeze them out fairly easily by changing the margin requirements, all that kind of shenanigans that they did. So I think there is a lot, it isn't, I always think it's a peculiar market, because it isn't really a very, sort of independent price finding kind of a market, because the people who run the markets are private institutions who run them for profit, which is a bit different to like the stock exchanges and so on. You have a lot less interest in what goes up and down.
There's a huge amount of business being done globally in what's called CFDs, contracts for difference. Now, these are websites which basically are retailing or dealing with retail customers who can leverage up 5-10 times what they have. Now, the retail customer won't be putting a limit as such. He can, but he won't be actually putting a limit himself often. He'll say, oh, I'm going long silver or going long gold, and he'll buy it for 10 times what he's got or 5 times what he's got. But behind the scenes, the CFD website has to have a limit. And where do they lay those limits off? They lay those limits off on COMEX, so that now becomes visible to the big boys in the bullion markets, who can see where all those limits go. So if the price goes down below a certain limit, the CFD website is selling and then simultaneously taking out the small trader. And they do say that the numbers vary according to which CFD website you read, but they do say that 90% of people dealing in CFDs lose 90% of their money in 90 days. It's called the 90 rule.
90 rule, yeah. The CFDs are an absurd instrument of gambling in a market that you have no control over. So it's definitely to donate the money to somebody. I always say, like, don't bother with CFDs. But a lot of your viewers and a lot of my viewers still bought gold at the 5,000 whatever. They bought silver above 100, because most retail investors' strategy is buy what's popular, what's gone up a lot, sadly, and it's a strategy of sort, but not a very good one. And it's something people hopefully will make a bit of an impact here with, which is today's video. But those guys are sitting on pretty significant losses if they're still holding, right? You did a video earlier in the year, and you referenced a sort of 140-year-old study, and it showed that, after these kind of crashes, there was some hope, right? Could you walk us through that in a sort of summary? I think people might find that interesting.
Well, it's more of a stock market study than a study of gold and silver, because the history of gold and silver really isn't that long. We only go back to 1971 in terms of a free market price. But history does show us that when stock markets crash, it does vary. I think the Great Depression is a different situation. But when stock markets crash, more often than not, the last phase of the crash is very, very fast down. And then there's a sudden and furious rebound, which then leaves a lot of people saying, I wish I had bought at the bottom. So the perception changes from, I wish I'd sold at the top, to, I wish I'd bought at the bottom. And by the time people get around, they say, oh, I like the price. And by the time they get around to putting in their buy order, it's already too late. And I've seen that in countless crashes. I mean, when I say countless crashes, there are not that many, maybe 5 or 6, to be honest, in my entire career of 50, 60 years. So 5 or 6 crashes. But what we always experience after there's a short, sharp sell-off is people wanting to come in and buy at the bottom, but the reality is they always miss the bottom. And as we go into the bottom, people are usually selling literally at the bottom. The one I remember specifically was the 1987 crash, where we got the call to sell everything on the Friday. And due to a hurricane in London that day, the brokers weren't at work and we couldn't get through. So we had to send a fax, but that fax was not picked up until the Monday morning, which was Black Monday. So you can guess what price the seller sold at. It was obviously the worst price that he could ever have had. There were obviously people on the other side who came in as buyers, but they weren't buying at the price he was selling at. They were buying at a much, much higher price. So what I can tell you is it doesn't make sense to try and guess the bottom or the top. Nobody can do that. If you don't have enough of something, you should be buying very gradually. And if you're checking the price every 5 minutes, you probably have too much of it and you shouldn't be buying any more. And maybe you should be thinking about whether you top slice it.
Yeah, I think that's a very good lesson. I think most people who are concerned or worried to a degree where they're not sleeping, or as you say, refreshing their broker every 5 seconds, it is a position that's always too large. And I think that's the simplest risk management is always just like, just have less of the particular thing that's worrying you. So I appreciate you mentioning that. Now, if we zoom out a little bit into sort of macro land, there are quite a lot of things happening in the US right now with the dollar. The government might be seeking to weaken it.